Good morning, everyone. Welcome to this update for global stocks and commodities for the 16th of December. This will be the final edition for the year because I'm sure next week no one's going to be too focused on the markets. So we've had obviously a very volatile period since the start of this current correction in the first week of October. And the normal Christmas rally looks to be in pretty severe doubt at this stage. Now, there's still a week to go and markets are really volatile and can turn on a dime. So I wouldn't say that we can't get a rally, but certainly the odds are against it at this stage, which means that the main US indices will close the year very likely in negative territory, which certainly was not what anyone was expecting when we saw that meteoric rise at the start of the year. Nevertheless, let's take a look at how the market is going to finish the year. But my theme today really is that despite all the incredible doom and gloom that's out there, and it really is quite extreme at the moment, is that this just still remains just a correction. This is a period of time that is reasonably similar to what we saw in 2015, 2016. So nothing really has changed in the last few months. It's just, as I said last week, it just feels bad. It looks bad. There's a lot of red on the screen and it feels bad. But we've got to keep perspective through these periods because it's easy to to get a bit despondent about it and just chuck everything out of the cot. So resist the urge to do that because the market, the actual facts around the market are not that bad. So in this update, yes, it was another ugly week, but really nothing has changed. And this is just so much about the analysts and the commentators making projections into the future, looking through a very negative lens. And it's not actually about factual evidence. We're still in a situation where this is just so much about perceptions. We'll do the normal stock and commodity trend update. And last week in Portfolio Analyst, to just continue to look through the opportunities, and there are plenty of them. Now, none of those stocks have started bouncing yet, but they're certainly down into the area where there's some extremely attractive buys, but they're not in your traditional areas. Now, looking at the US market, the S&P was down by 1.3% on the week and finished very negatively. All the indices and sector indices were all down. They all closed close to their lows. So there was no buying into the end of the week at all. So, pretty negative. And the S&P is now down 2.7 for the year, which after that absolute rip-roaring start in January was not what anyone was expecting. But despite the fact that the S&P is down by just 2.7%, more than half of the S&P stocks are down by more than 20%. So there is a lot of carnage when you actually look at the individual stock level. And I think most people would have been scrambling to have made any progress this year. But I think what we've got to keep in perspective here is that from the 2016 low in February to the 2018 peak in January was a 62% gain. So it's unreasonable to expect that markets are just going to continue to stack on gain after gain after gain. And so if this turns out to be a year that ended up, let's say, down 3% on the S&P after a 62% rise over the previous 2 years, is that all that bad? Now, that's at the index level. I know that individual stocks have done far worse than that, but please keep this market in perspective because it really is at this stage just looking like a rerun of 2015-16. The US economy is still in reasonably good shape. Now, I know there are issues with debt, and I know there are There are issues, perhaps building in the bond market, but again, that's still about perception rather than actual fact at this stage. We haven't had the bond inversion of the all-important 2-year, 10-year spread. So the situation in America is still reasonably okay. The problem is that we've got weaker data elsewhere, Japan, Europe, China, and of course some of the other developing countries are in a bit of strife as well. So that's the situation we've got at the moment, and the market is in a mode of reacting to all the bad news. So every bit of news is portrayed in a poor light. Every bit of data is being framed in a very negative tone. And that's just the kind of market we've got at the moment. People are not looking for reasons to buy. They're looking for reasons to sell. And when you've got that sort of environment, then the market inevitably is going to go down until there is sufficient compelling value to turn that around. We also saw $46 billion come out of US mutual funds and ETFs during the week, and that was a record. So certainly there is a significant movement of capital out of the market. But let me reiterate once again, that does not mean that this is a market top. It just means that within the time period of the last few months, people have now got very negative and they've started moving money out of the stock market in record amounts. Now, that could be a sign that we're close to capitulation, that there's been a lot of throwing of towels out the window and people have just capitulated. Now, I'm not saying that that is the case, but perspective is so important here. Equally, there is not a case to be made that this is a major market top either. So we're still in this limbo period, and I think that's the important perspective that I would like you to take out of this edition. The US dollar was higher on the week. High yield debt is still volatile and in downtrend, so it was up and down a bit, but on balance it was down for the week. So the higher yield corporate area is under pressure, and that's exactly what you'd expect to happen. It'd be incredibly unusual if that wasn't happening at this stage of the business cycle. And the 10-year yield recovered very slightly. You might recall we were at 2.85% last week. We recovered fractionally, but certainly the US 10-year yields have stopped rising. It would be far more of a concern if we were getting bond inversions when the yields were rising, but the fact that we're getting some shorter-term bond inversions when yields are actually falling, which just means that the shorter-term rates are falling more slowly than the longer-term rates, that's actually not an issue. That's nowhere near as much of a problem as if inversion occurs when rates are rising. So again, we need to just keep proper perspective on things here. So let's jump in and take a look at some of the charts. This is the S&P, and you can see that we actually closed below the lows of the 29th of October and also the low of the 7th of December. So market's definitely in a very negative tone, and you'd have to say that the odds are now that we will probably go a bit lower, and we will probably try and explore the support around this 25-30 area. So I think you've just got to acknowledge that the path of least resistance is down, and that's all there is to it. So I would expect quite possibly some more selling at this stage, but we'll just have to wait and see. Trying to respond to this market on a day-to-day basis is near on impossible. So it's best just to position yourself for the medium term and for whatever outcome, be it higher or lower, and wait and see how it plays out. Now, just take note of a couple of things. Just look at how far below the 200-day moving average is, the S&P index is. Have a look at the blue 50-day moving average line crossing the 200. So it's only just occurred in the last couple of days. And the fact that during this correction period, the S&P was above the 200-day moving average on a couple of brief excursions. Then we'll go and we'll look at the NASDAQ. So you can see the crossover occurred roughly the same time. So the NASDAQ, not a lot different, slightly weaker than the S&P, and that's a lot due to the money that's coming out of the FANG stocks. But where the real weakness is showing up is in the Russell. You can see that the crossover occurred a long time ago in the Russell. Russell was unable to get even remotely close to getting back above the 200-day, and now it's way below it. So certainly we're seeing weakness in the smaller end of the US market, that's for sure. And that's not a particularly great sign, but the small caps are always going to be more volatile. US dollar, you can see, is really still tracking higher. And that, of course, is keeping pressure on the Australian dollar. So the Australian dollar, we had a little breakout here a week or so ago, but we're back down now below 72. Now, just while I'm here, let's look at the ASX 200. So we're still in downtrend, quite clearly. Lower highs and lower lows. The Australian market, however you want to slice it, is in downtrend, and we're now breaking this 5,600 level, and I would expect that the Australian index will go lower on Monday, given the weak finish in the US. And it's really the banks that are causing the grief here. So the banks continue to slide in Australia, and there's plenty of other sectors that are following that down as well. So the Australian dollar down to 71.8, and I think this is there is increasing acknowledgement that our economy is not going very well, despite what the RBA has been saying all year. They're now starting to change their rhetoric, and of course politicians are always going to paint a rosy picture, but I think there's increasing acknowledgement that we've actually got some real issues, and I think it's really only some windfall commodity exports in LNG and iron ore that seem to be the only bright notes at the moment. And I feel pretty nervous given the way that a lot of things are happening in our economy, with the housing market coming off sharply at a time of record household debt, a really struggling manufacturing sector, the fact that we're only being held together with sticky tape based on commodity prices. What happens if commodity prices turn south again? I think we are in a very, very precarious position. The ASX 200 was, I'm not sure that is correct. Sorry, I may not have amended this from last week. The ASX 200 finished last week at 56.21. Yeah, sorry, that's an error. We were down more than 100 points, so forget that. That's incorrect. The banks were the weakest sector there, as I just explained. Now, precious metals, gold lost $10 after breaking out above 1245. No real surprise. We've seen lots of false breakouts in gold. But look, it's only down $10. It's a pretty minor retracement at this stage. It's too early to say if we're going to see a new trend emerge. And precious metals not really giving us much of a lead yet either. GDX rose early in the week and then gave that back towards the end of the week. Other commodities, copper eased back a couple of cents again. London Metals Exchange inventory still falling, so that really flies in the face of the global economic slowdown. So I still really see the copper market as being one where the price is being set in the futures market based on perception, and it's not the copper price is not as much being set by current day supply and demand. Crude oil fell slightly to 52.20. Still volatile, and $50 is still our very key support level. But it's steadying a bit because we got the second week in a row where inventories were slightly higher, so that's providing a little bit of relief there. There's the copper chart, still really just going sideways. And there's our copper inventory levels still in decline, and crude oil finishing at 51.2, but starting to find a little bit of stability after that massive sell-off from 76 down to 50. So to wrap it up for the final edition for the year, the atmosphere is pretty poor, I have to say, but it's vital to keep this in perspective. Things in the US aren't that bad, and if this is a major topping process, if we have seen the end of the bull market 2 months ago, then this time it would be different. And we know that that's rarely the case. And when markets have been going up, people have been able to justify that, yeah, they're going to keep going up because this time it's different, and it rarely was the case. And I don't think this time it's going to be any different either. All the conditions for a major top are not in place. There's just none of them. It's all about conjecture and projection at this stage, and not about facts. Portfolio analyst this week, I'm going to be looking at how to hedge the risk, because there certainly is some short-term risk out there. I'm quite neutral on the medium term, and I'm still reasonably bullish on the longer term for all the reasons that I explain week after week. So I think it's just a matter of keeping yourself safe for the moment in the shorter term, and just let markets do their thing and play out. So that's it for this year. I'd like to wish everyone a wonderful and very safe Christmas New Year period, and I'll be back with you early in January. So that's it for now. Cheers.